Hello and welcome again to Charles Kelly Money Tips. I'm the author of the book Yes, Money Can Buy You Happiness, and I've been a financial advisor, or was a financial advisor, and working for banks and insurance companies and for myself for over 25 years. And I hope you're having a great day wherever you are, and I will be looking out for you on Facebook Live and on my podcast on iTunes and Stitcher. So what's been happening today? Well, today, you might not be listening to this on the day I record it, but it is the day before Brexit. And tomorrow, in about 24 hours' time, the UK will be leaving the European Union. Now, on the back of this and on the back of perhaps the general election result in December, which has broken that deadlock, that sort of almost like a hung parliament in a way, and house price growth has soared to a 14-month high. And I say soared, don't get too excited because it's only gone up by 1.9%. But that's better than, it was languishing at less than 1% at one point, depending on which month you sort of cut off the year from. But the Nationwide reported that to January, it's recorded a growth of 1.9%, which is pretty good. And you'll probably get slightly different figures when the Halifax publish their report. And then the Land Registry report comes out, which actually records the completion figures, but they might take a month or two to come out for last year. So that's what's been happening. Now this could be due to pent-up demand, so everyone's out. But a lot of agents will say, well, January's quite a busy day anyway, a busy month anyway for house. People tend to get out in January and start looking after Christmas. It goes quiet November, December, but it's still looking good. Obviously, estate agents are getting a bit excited now, aren't they? They're all, oh yes, it's all on the up. The Association of Chartered Surveyors are all reporting good stuff. They're all upbeat. I had a leaflet from an estate agent who said 4 times more buyer registrations in 2020 versus 2019. Well, I don't know how he manages to do that, like in January. Surely, does he mean for the month or for the whole of the year? Does he mean he got more registrations in January than in the whole of 2019? I don't know. He said house prices rise by 3% in the final 3 months of 2019 in his area of sort of North London, Hertfordshire, and 10% more property sales agreed in 2020 versus 2019. Does that mean he got more sales agreed in January? Because it's not even the end of January yet. Than 2019. Now, I know this guy. He actually does sort of spend his life on Rightmove analysing figures, and he can give you all sorts of figures. So he's obviously upbeat. This comes on the back of a very quiet period for estate agents. Some of the estate agents I spoke to said that sort of period, 2017, 18, 19, was the worst they'd ever seen. Having said that, some of them are only 15 years old. Well, all right, maybe not. I made that up. Okay, 16. Okay, well, all right, 17 years old. Let's say that. They haven't had a lot of life experience yet, but sorry if you're in a state. I'm just having a little joke because a lot of them are kids who've probably only ever seen one recession in their life. They've grown up believing that we've always been in Europe. So they've only ever seen that the back of that 2008 recession. Perhaps some of them were still in short pants when that was happening, let alone the ones in the 90s and the 80s crash, and even going back further. There's been lots of ups and downs in property, and you've got to remember that property has it is still high. If you look at the fundamentals, people still can't afford to buy houses. Ordinary buyers and first-time buyers still can't afford to buy houses in much of the country, particularly in the southeast, where in London you might need 15 times the average salary to buy a flat. In St Albans, it's not far off of that. I think it's something like 12 times the average salary to buy a property in St Albans in Hertfordshire, which was miles out of London. So, the fundamentals are there, and you've still got central banks printing billions of euros and yen and dollars to sort of buoy up the market so that we don't have a recession. And you've still got the stock market on an 11-year almost continuous bull run on an 11-year high, with many investors such as Warren Buffett feeling that everything is a bit overpriced. So the fundamentals still point to, don't exactly point to a boom, let's put it that way. And yeah, now just getting back to these figures, prices up 0.5% on December, but Nationwide, strange enough, predicts that house prices will be flat in 2020, which is a bit strange. They said the average value of a UK home is 215,000. So when you think that's average across the whole of the UK, when you think the average salary is 27,000, you know, even if you put two salaries together, you're going to need like nearly 4 times joint incomes to get you a mortgage of that amount. Unless, of course, you've got family money and the bank of mum and dad chipping in large deposits. You know, they're not going to be able to get on the housing ladder unless you live in somewhere maybe like the northeast, Newcastle, where you can pick up a house for 50 grand maybe. So it's still going to be difficult for people. Now, Zoopla showed that cities outside of the south of England saw the biggest rise in 2019. And I think other figures showed that the northwest of England was going up quite a bit. But they say 6.1%, the highest in the country, was seen in Edinburgh, 6.1% growth in December 2019. And Nottingham was the second, 5.2%. So if you're around the Nottingham area, you've seen a good rate of return on the capital side of your property. But some parts of the country, I mean, a couple of years ago I was looking at parts of the Midlands, not far from Wolverhampton, and I looked at the prices there. They hadn't moved since 2008, and you know, parts of the northeast fell last year. So you know, even if you get a 5% rise in some parts of the country, if it's been falling or not growing by that much, you know, it's just about catching up. Obviously, London did fall as well in the last couple of years, but you know, if you look back, say, over 10 years, London's gone up so much that you know, just one property in the centre of London could have made you £1 million on just capital growth alone, whereas you know, getting 5% growth on a property that's only worth, say, 50,000 to start with is only £2,500. So it's hardly anything to write home about. So you've got to look at these figures and analyse it for yourself and decide where you want to invest and what you want to do. But if you do want to invest, then best to learn about it, learn about the various strategies, learn about whether you're going to do straightforward buy-to-let, HMOs, house and multiple occupation, whether you're going to do serviced accommodation, perhaps holiday type lets, whether you're going to do flips, refurbishment and refinance. What are you going to do? Are you going to develop, would you like the idea of developing office to resi? So there's all sorts of strategies, including some strategies which can mean that you don't need your own money. You can get into property using other people's money and with no money down yourself. There are lots of strategies to do that. And if you're interested, just contact me and we'll put you in touch with a course provider that can give you a free day, a taster day or a free taster weekend, absolutely free. And then you can decide when you're there whether you want to go into other courses on a deeper level, which would be paid, but you're under no obligation to do so. I've been on several of these and I think they're really useful. You can learn so much just from a free taster, because you realise then that there's lots of different strategies. It's not just about, oh, let's go and do a buy-to-let. Let's buy a house down the road because I like that area, because I would live in that area, so I'm going to buy a house there, which could be the wrong thing. You know, you've got to know how to analyse these things. You've got to learn how to analyse the yield and the rate of return, and you know what you can expect, how to find the best areas for lettings, how to find the best areas for maybe growth, how to analyse these things so that you're not ending up with a property that is difficult to let and maybe empty for months. You might want to know a little bit about the law on letting, yeah? Do you think that would be useful to learn a few of the rules and regulations? The Tenants Act, for instance, the Tenants Fees Act, what you should be doing about gas safety and all these things. It sounds complicated, but it's not if you know what you're doing and how to go about it. So let me know if you're interested in that. Just contact me on Messenger or on at my email, charles@charleskelly.net, charles@charleskelly.net. Now, the Bank of England finally, the Monetary Committee voted by 7-2 to keep UK base rates at 0.75%. There was a rumour that things might the interest rates might go down because they thought that they want to stimulate growth, but it seems that they're saying that, well, the cost of living is the economy is I'm just going to look for this here. The economy is doing okay. So the Bank of England said, well, if it's picking up, there's no point in then reducing interest rates if the economy's picking up. So if the economy was stagnant and things are not moving, they might then drop interest rates back. But there are some good mortgage deals around at the moment. There's some really cheap deals. So if you are borrowing, that there are some good deals even on buy-to-lets and that sort of thing. So there you go. That's really about it. Another little bit of news: Wonga has been asked to compensate 400,000 missold loans. Now Wonga was quite revolutionary at the time because you could phone up, get a loan, and it was in your account within minutes, rather than going to a bank and grovelling and spending hours there and then getting the money in 3 weeks' time. So they did, revolutionise things. But it seems that maybe some of these loans have been missold. Missold doesn't mean they're crooks or anything. It just means that there's some tick box that hasn't been dealt with, or some people say, well, I wasn't told that you have to pay it back. I wasn't told you had to pay interest on it. I didn't know that. I didn't know what the interest rate was. Well, it was sent to you. You had it in a big pack there. You just didn't read it. So anyway, we'll see how they get on. And the banks have been asked to explain their 40% overdraft rates, not because they're going up to 40%. Yeah, 40% for an overdraft when the base rate's at what? 0.75%. They're charging 40% on their, is that 60 times the base rate? I don't know. But, they've been asked to explain it, not because they're charging 40%, but because they all seem to be charging the same 40%. Well, how's that? Is that a cartel? Have they got together and said, we're all going to charge 40%? A little bit suspicious, isn't it? So, you haven't got some charging 35 and 30 and some charging 50. No, all the major ones are charging 40%. Well, that smacks of, let's get together in the dark room, smoke a few cigars, and let's all decide to keep it at 40%, shall we? Well, as far as I know, that's not legal. But anyway, the regulator will sort them out. But if you do go into overdraft now, you could find that you're being charged 40% because the regulator pulled them up on charging these excessive fees for people going overdrawn. But what the banks argue, just to give them their side of the story, is that when you've taken away the fees that would be charged for unauthorised overdrafts and that sort of thing, sometimes people are better off with 40% if it's a temporary overdraft, like for a few days, because you're not going to get charged 40%. The annualised rate is 40%. So if you go overdrawn by £100, they're not going to charge you £40 or 40% of that £100 for a day. They would charge you an annual percentage rate of 40%. So they're not exactly loan sharks quite yet. It's not like the Vic as they have in these gangster mafia films. But anyway, they're not far off the mafia, really. But so they argue that it would be cheaper for people now, even when you take away the other fees. If they're in overdraft facilities for a few days, that's fine. But if they're going to have a long-term overdraft, they would be better off converting that to a loan, and then they would pay lower rates, obviously. So that's it, really. Thanks for listening. And if you're out there looking for a house, you're joining lots of people. Well, let's hope that things will pick up in 2020. We'll have a better year or two now that there's a bit more confidence around. We've got the general election out the way. We're leaving the European Union tomorrow night at 11 p.m. Now, a lot of people are not celebrating that, but at least it's out the way. It's done and dusted. We're not, we've had 3 years of 3.5 years really of uncertainty and hung parliaments and governments without a majority. So we need to get things moving. The government will start hopefully spending money, particularly in the north, and revitalising things and putting some capital into the economy for projects and infrastructure projects, and that should stimulate the economy. Also, just one other final thing: the Home Office have been advised by the Migration Advisory Committee to drop the minimum salary for work permits down by I think to 26,000 from 30,000. This is because when free movement stops, which won't happen till next year, they'll need to have an Australian style points-based system in place for that. And they feel that the salary rate at the moment is too high. And it is too high. It was put up really to almost stop immigration from outside of the EU. But companies and things like the care industry and various industries need people from overseas. So they're hopefully going to make the work permit system a little bit more workable for employers. So there you go. Thanks for listening. This is Charles Kelly bringing you money tips to help you save, earn, invest, accumulate and enjoy more money. And once again, if you're interested in learning about property and how to become a property investor using none of your own money, contact me on Messenger or at charles@charleskelly.net. Thanks for listening. Bye for now.